Good evening. It is Sunday evening, October 22nd, 2023. It's almost 8 p.m. on the East Coast. I'm getting a slightly later start to this video this week than I normally do. I prefer to do these videos on Saturday morning, but every weekend's a little different for me. One of the things that I do that some of you probably don't know, I also teach yoga and acro yoga. So this was a busy weekend for me in the yoga world. And so that's why I put this off until Sunday night. But it's always perfect. And I really enjoy doing these videos every week. It's very important for me in terms of my analysis, my process, and getting my thoughts clear and really um, viewing the entire market, trying to understand what's happening and get new ideas for the week ahead and just for the future. Um, Big picture thoughts first about last week's action. So, for the equity market, it was ugly. It was a really ugly week, pretty bearish week overall for stocks. A lot of big tech leaders like Tesla and NVDA got hit pretty hard. We saw a big spike in the VIX. As you can see, I have the VIX chart here. This is the highest the VIX has been since March. And remember, we think back to March, for a couple of weeks in March, it felt like, we're having Black Monday, or the market was about to crash with the regional banking crisis. We even had the issue with the Swiss banks, the big Swiss bank that got forcibly taken over basically because it was failing. Put it all together, March was ugly and very scary. Now we know what happened. The Fed came in, central banks came in, backstopped everything. The Swiss National Bank sort of backstopped the takeout of Credit Suisse. So they saved the day. It's feeling, just reading the tape, feeling the market action at the end of last week, it's feeling almost as bad as it felt in March, in mid-March. But I'll say that sentiment is not as bearish as it was in March. For some reason, it feels like people are kind of desensitized to what's going on. And maybe there's not a big financial headline that's hitting everybody in the face like the Silicon Valley Bank failure was back then. So, I'm not sure exactly where to put my finger on it, but it doesn't feel like investors are as afraid as they were then, which is interesting because there's other things happening in the world. Obviously, in the Middle East, there's bad things happening. We have no idea how that's going to play out, but there's certainly a lot of things that could go wrong and sort of have been going wrong. So if I just read the overall market right now, what's happening, what's not working? Well, the damage underneath the surface is really extensive. The Russell 2000, new 52-week low, financials are breaking down, and the sectors that are working, or at least not going down, are, McDonald's, Procter and Gamble, big oil companies, not the sort of leadership that you would want to have in a healthy market environment. And so if I look at the transports and the incredible downtrends in transport stocks, base metal, so just the copper chart is pretty ugly. A lot of miners are in pretty pronounced downtrends. So whether it's zinc, copper, base metal mining companies are getting sold off pretty good. And now tech, which was the former leadership sector of the market, is getting hit hard. So there's not much working. Usually we don't want oil stocks to be the leadership sector, and that's basically what it is. And Procter and Gamble Costco, we don't really want those stocks to be uh, the market leaders in a healthy market environment. But what also happened in the last couple of weeks? Well, we had this tremendous U-turn in gold. So gold dropping down to the 200-week moving average. I mean, it was almost a perfect touch of this big moving average, this big long-term moving average, and then a incredible reversal to the upside. Um, One of the things I got right in the last couple of weeks was calling for the gold bottom near 1820. I kind of expected it to bounce, but I wasn't expecting it to bounce almost $200. I was thinking maybe we get back to 1880, maybe 1890, but certainly not 2000 or 2009, which is where it got to at Friday's high. It closed at 1994, but still a very big bullish weekly candlestick. And you can see the RSI, it's got this channel that it's been in for most of 2023, broke out from that momentum channel last week. So this is a very impressive move in gold. And I sort of wrote a blog on Friday morning called $2,000 Gold in the Path of Least Regret. And sort of the big takeaway from this little blog post is just simply that a lot of gold bug investors do not think this rally is going to stick. They think it's due to the tension in the Middle East, investors sort of fleeing to safety, and they're skeptical about this, and that's natural. I mean, it's a very big move in a very short period of time, but I sort of I agree it's a big move, and I agree that gold could certainly pull back, maybe back to 1970 or maybe even 1960 early this week. That's certainly plausible. In fact, we just saw a little downdraft in the overnight futures trading. But bigger picture, so not trading on the hourly chart and looking big picture of the monthly chart, I think the way I view gold here is that the risk of not being long for the breakout above 2100 is greater than the risk of being long and watching gold fade back into the 1800s or maybe even all the way down to 1800 in the next couple of months. Now, again, I can assure you gold will be volatile here. We're probably going to have some more $100 moves on a weekly basis, here in Q4 of 2023. But another thing that really sticks with me is gold is not the current macro environment, except for the war stuff, is generally not favorable for gold. We have higher interest rates, a higher price of money, positive, real interest rates. One of the main catalyst tailwinds for gold in the last decade has been real rates that were negative. So now the entire treasury yield curve is in positive territory. 10 years at almost 5%. 10-year expected inflation is somewhere around 3 or 3.2%. So it's extremely positive real interest rates, right? Generally, that is a major headwind for gold. So one of the points I made in this blog is that, when the market is acting in a very different way than you would normally expect it to, it's changed character in a very big way. It's time to pay attention. Something's happening, and maybe we don't fully grasp what is driving the bid into gold. And maybe it's not on the headlines on financial news sites, but it will be, one day, right? And so we just need to figure it out. This U-turn, this V bottom, it's more than a V bottom actually in gold, is remarkable. And it's one of the most impressive 3 to 4 week moves I've ever seen in the gold market. So I think this is something to pay attention to. And there's a lot of technical factors that are now flashing sort of a green light on various time frames. And while, as I said, in the near term, gold could be vulnerable to a little pullback, maybe back down to the 1960 area, bigger picture, I think it is very constructive. So we talked about that. One of the other, so definitely there is a war bid in gold. I just don't know how to quantify it. It could be $20 an ounce. It could be $100 an ounce. I can't quantify exactly how much the terror attack and the threat of war in the Middle East is putting a bid into gold, but it certainly is to some extent. But perhaps even more is the sort of move in Fed funds markets in the last few weeks. When gold dropped down to 1823 the first week of October, there was a full expectation there would be one more rate hike from the Fed this year. Okay, it would be at the last Fed meeting of the year, there would be another rate hike. Well, that has changed in a big way. And now there's basically an 80% chance that there will not be a Fed hike at the final two meetings of the year. And there's almost a 75% chance that the Fed is done. Okay, so this is according to Fed funds, futures markets. That's the way the market is pricing it right now. And, if I look through various stock, sector charts, it's fully understandable. It's very clear that the stock market has begun to price in a weaker economy, a weaker consumer in the last few months. And they've priced it in a big way. Just going through the transport charts, you can see that. This speech from Philly Fed President Harker about 10 days ago really caught my eye, was quite notable. And he very clearly said that by doing nothing, we are still doing something. And actually, we are doing quite a lot. So basically, holding rates steady will let monetary policy do its work. And he believes policy rates are restrictive and they will continue to press down on inflation and bring markets better into balance. Okay. These words are in some ways subtle, but they're quite powerful. And what it spells to me is that the Fed is continuing to do this portfolio balance channel in reverse. The Fed is continuing to reduce its balance sheet through quantitative tightening, while the fiscal side, the Treasury Department, is selling loads of Treasury debt, loads of T-bills, notes, bonds, right? The US debt is trending much higher. We're almost at a $2 trillion deficit for 2023. Next year is an election year, so you can pretty much guarantee we'll be running another big deficit next year, and then most likely the year after as well. So you have this massive national debt in the US. You have these massive unfunded liabilities that the government has to citizens. And the only way you pay for that is you issue more debt. So I believe that a big part of what has happened in the Treasury market has to do with the supply of new debt that the Treasury is constantly in the market to sell. So there's new issuance of debt on a regular basis. And this is happening at a time while the Fed is not a buyer. The Fed is actually allowing its balance sheet to roll off. It's allowing its balance sheet to continue to contract. So they're doing the opposite of what they were doing during quantitative easing. And this is basically, I believe, forcing the yield curve up. And it has also done a lot of the Fed's tightening for it. So that was also one of the big things that's happened in the last month, this move up in the 10-year treasury yield from, let's say, 4.3% to almost 5% has created tighter financial conditions. And that is doing the Fed's job of tightening for it. So they don't need to hike the Fed funds rate further. So I believe that the fact that the Fed is done, I believe the Fed is done. I've been saying the Fed is done for the last couple of months. The market now is pricing in the Fed is likely to be done. I believe that is bullish for gold as well. That's a big turnaround from thinking that the Fed had to go higher, had to go to 6% maybe. Now the Fed is done at 5.5%, and maybe at the beginning of next year we can start talking about, well, when is the first cut? Okay, and especially, and one more point I want to make here though is a lot of people are thinking, well, there's a lot of selling in the treasury market from China and other holders, right? I don't think this is a mass flight out of, the treasury debt. If it was countries trying to get out of the dollar and get out of treasuries, well, the dollar would be much weaker than it is today. In fact, the dollar is extremely strong, and even just this little move lower in the dollar and higher in the euro in the last few weeks is a blip on the chart. The euro dollar pair went from 112.50 to 104.50, and it's just moderated a little bit back to 106. But the dollar is still very, very well bid. And this is not de-dollarization. This is not the world leaving and fleeing the US. It's absolutely not. This is simply market dynamics in the fact that there's a lot of supply of treasury debt. The Fed is not a buyer of that treasury debt. And so in order to incentivize other buyers, yields have had to move higher. Okay, we're sort of finding that right level. I think there's actually a very good chance that 5% on the 10-year is high enough for the time being. Okay, especially if the economy is weakening like it appears to be based upon a lot of moves across the market. Again, the VIX also spiking pretty high. Generally, gold and the VIX have a positive correlation. So if the VIX is super low, like down at 13 or 14, stocks are just gradually trending higher. Usually that's not a bullish environment for gold. But when there's a lot of volatility in the stock market and the VIX is above 20, usually that is going to be a time when gold is moving higher and at higher price levels. So again, the fact that the Fed is likely done, there's been a big pivot in the sort of thought process around what the Fed is going to be doing at the next couple of meetings. And then you have this market volatility and this big move up in the VIX. Those are all favorable factors for gold that can all help to explain the reversal from 1823 to 2009 that we've seen in the last few weeks. So going back to the stock market, big picture charts like Caterpillar, Tesla, Freeport McMoran, even Walmart and Costco started to get sold off last week. American Airlines, Royal Caribbean Cruise Lines, a lot of transport charts are just flat out ugly. Here's the American Airlines chart. I mean, there's probably very few downtrends out there that are stronger than this one, especially, like among companies in the S&P 500. AAL hit 19 in July, and it's down to 11. 19 to 11 in 3 months for American Airlines. So what is that telling you about the consumer and travel? I would say that the market is a leading indicator, and this chart is telling us the consumer is weakening, spending is weakening, and airline profitability is also deteriorating. Some of that has to do with higher price of oil, of course. Royal Caribbean, very similar costs and headwinds as an airline company. This is a cruise line. So from 112 to 80, also in a very, very strong downtrend. So just, taking a look at AAL and RCL, I mean, these charts are very similar. These are very pronounced, very powerful downtrends in these stocks in the last 3 months. And these are consumer sensitive companies. These are the sorts of charts, stocks that are going to give us a glimpse, a real time look into the consumer in the US. And this is telling me the consumer is tapped out and consumer spending is really, weakening. This is not the kind of environment that the Fed is going to be tightening, okay, in which the Fed is going to be tightening. I really think the Fed is done for the next 2 to 3 meetings. And I think definitely by early next year, maybe March, maybe April, there will be a conversation about when is the first cut going to happen. I'm not saying that the first cut's going to happen in March, but I think the first cut will definitely happen next year, maybe as soon as May or June. So the conversation is going to pivot from do we need to do more to when do we need to start easing, because inflation is not the problem it once was. And we're seeing some real weakness in the real economy. So let's keep going here. RCL, transports, AAL, RCL, small caps, IWM. So, you could have looked at these charts a couple weeks ago. You might look at the Tesla chart or the NVDA chart or even the Caterpillar chart, and you say, this market is strong. These mega caps are really working. But if you looked at small caps, they haven't been working basically all year. And certainly they haven't been doing well in the last few months. But now, if we look at the mega caps, Bank of America almost down to a 52-week low. Here is, NVIDIA, the tech titan, the AI darling. This stock topped in August after it reported blowout earnings numbers, right? So that, recall back to August, everybody was gaga over NVIDIA. All the talking heads on financial TV were gaga over NVIDIA. AI, blah, 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 blah. That was the top. It peaked on the day it announced blowout earnings. And it's proceeded to put in a series of lower highs, and now it's working on lower lows. And I drew this little diamond top pattern. I don't put a whole lot of weight into this chart pattern, but it does represent the amount of price action that has occurred in this range between 400 and 500 in the last several months. So it's now starting to break down from that range. I don't think it's confirmed to have broken down yet, but certainly if it breaks under 400 this week, that would be a clean breakdown from a multi-month trading range, and we could call it a multi-month topping process, topping pattern. And this is a big one. So this was literally the number one market leader from May through August. Okay, one of the best performing stocks in the entire stock market, and its market cap has a huge impact on the S&P 500 and the NASDAQ 100. So it is a market leader, and it could also be a market leader on the downside. So this is one we really need to watch carefully. Tesla, also absolutely another market leader. And look at what it did last week. So it reported earnings, profit margins are contracting. It missed on a number of key metrics, and investors were not happy. They sold it after the earnings report, and they kept selling it throughout Thursday session and Friday session. And just they're sort of running, I listened to the conference call, or at least part of it. They're running into some issues, law of large numbers. I mean, the numbers can only get so big, and you cannot keep up those rates of growth like 50% or 60% when you're $1 trillion company. Maybe you could do it at 50 billion, maybe you could even do it at 100 billion, but you're not going to grow 50% a year at $1 trillion+ market cap. You're just not. and you're not going to be able to sell that many more cars, especially at a very high price point that's way above the average price point of other car manufacturers. So Tesla's running into some real issues in terms of its fundamental, business model, and it definitely running into some technical issues in terms of its stock chart. Okay, so this is a significant breakdown of a market leader. So just those two stand out. Tesla and NVIDIA both got hit hard at the end of last week. Both are former leaders, darlings that are getting shot down. I love to look at Freeport-McMoRan because it's one of the biggest mining companies in the world. It's a blue chip copper and gold miner traded in the U.S. On the S&P 500, and look at what it did last week. Down big on Friday, down almost 4%, and not a 52-week low, but a multi-month low. And do you guys sense a theme here? How many stocks topped during the summer and are in these pronounced downtrends in the last several months? Okay, and a lot of stocks making new 52-week lows on Friday, and many more making multi-month lows on Friday. So there's a large number of stocks in downtrends right now, and when you have that kind of downside breadth with so many key companies, key components of important sectors in confirmed downtrends, that's what a bear market looks like. Okay, so we are looking very much like this is the beginning of a bear market. Copper, we can argue about whether this is a bellwether or a key indicator of the real economy or not. Let's just keep it simple, and I'm going to say it is. And the fact that it is also in a confirmed downtrend near 52-week lows, trying to just cling to critical support at $3.50 a pound, not a good sign, either. Okay, I'm not trying to say that I think copper is going to go a whole lot lower, but I'm just going to say that it's the weakness and the downtrend in the chart is telling you that the economy is a lot weaker than a lot of the headlines tell us that it is. And whatever's happening in China is also clearly not very good, in terms of their economic growth. Caterpillar, another key bellwether, and look at what it did the final 3 days of last week. Pretty aggressive sell-off. It was previously sort of trading in a consolidation range since early August, and that consolidation range has sort of transformed into a downtrend. I think that that's a pretty good breakdown that it had last week. Now, it is still above its 200-day moving average, so I wouldn't say all is lost here. There's definitely some big support there around 240, but certainly if it loses 240 on a weekly closing basis, that would also be a confirmed downtrend. But a lot of charts out there also making lower highs in recent months and then lower lows and breaking down to new multi-month lows. So again, this is the evolution of bull market or counter trend rally in a bear market to more clear bear market action. Utilities, utilities are very sensitive to treasury yields. And when treasury yields move up a lot, utility stocks tend to drop, and vice versa. If yields sell off, utilities tend to do very well. So, it's very clear that this sector had been breaking down since the summer, and it really accelerated that breakdown in September. We got a little bounce as the 10-year sort of cooled off a bit from 4.9 to like 4.6, but looking like a dead cat bounce, and also looking like a sector that's in a confirmed downtrend. So you have this very interesting backdrop where you have these, economically sensitive sectors like transports, base metal miners, um, in these really nasty downtrends at multi-month lows or at 52-week lows in some cases. But you have, interest rates very sticky to the upside. Okay. And just put it all together, this is not a positive environment for, the stock market, with this backdrop of slowing economic growth and really high interest rates. Biotech. So, this is a sector that you can make a very strong case for. It has secular tailwinds. So, like longer term tailwinds as the baby boomers, retire. More than 50% of the wealth in the US is held by people older than 65. They all want to live longer. They all want to live better. And healthcare, pharma, and biotech are the key sectors to sort of make that happen. And the key beneficiaries of that baby boomer wealth and spending in their later years. But there's a lot of things that are also unfavorable for biotech that are going on right now, including the higher cost of capital. And the administration in Washington is really not terribly favorable for the biotech industry. So new 52-week lows for the XBI, and definitely in a confirmed downtrend. Former market darlings, Pfizer, Moderna. Remember, these are the vaccine stocks. These have been absolutely obliterated in the last several months, making 52-week lows, making multi-year lows. I mean, take a look at the Moderna weekly chart back to 2020 levels. So even though this company has over $8 billion in cash in its balance sheet, Pfizer has more than $40 billion, the growth is not there. The growth is not there. These companies are seeing declining revenues and lower profitability. In some cases, like with Moderna, likely to not even be profitable, okay, this year. So one of the very interesting things for me as an investor is, how do these companies like Pfizer and Moderna get growth back? Like, where do they get that from? Well, yeah, they have their own drug pipeline, but most likely it's going to be through acquisition. And so they're cash rich and in desperate need of growth, in desperate need of finding something to turn the sort of narrative around, that there has been company, they had their day in the sun during the pandemic with the vaccines, and now they're just a cash cow, fallen angel with no growth, right? And no growth prospects. So how do you turn that around? You find growth, you acquire growth. And so one of the most interesting things for me over the coming months is to look for the potential takeover candidates for these bigger biopharma companies. And that's going to be something that you can expect me to write about a lot more as well. Okay. I also think that XBI, it's just sort of from a longer term perspective. I'm not talking about a short term trade. I'm talking about sort of holding for a year or more. I think that this sector is attractive. I think the valuation is very attractive, and the sector's beaten down enough. It's interesting from sort of a long term portfolio holding. So look back to last June, the $65 level was big support in XBI. Well, we're almost there now. Okay, so we're going to retest that big long term support level at 65. I want to talk about some things I've gotten right recently, and also something I've gotten wrong. So some things I've gotten right. Natural gas, we had a very big upside move from 260 to 350 in natural gas from September to early October. Since then, it has corrected significantly, down about 15%. But the natural gas trade was a futures trade, absolutely short term. So that worked very well. Longer term, I think that you have to look for natural gas to set up again. It might do that here in the next week or so. Obviously, this 50-day moving average and sort of lines up with key support around 285 to 290. That support level could work. The only issue with natural gas is seasonality starts to turn negative here as we turn the page to November, and it stays negative pretty much through the end of January. So the seasonal headwinds are going to definitely weigh on natural gas a little bit. But longer term, if you think back to videos I've done 3-4 weeks ago, the longer term fundamental thesis for North American natural gas is still very strong. If we look out a year to 18 months with LNG, okay, we're going to have 3 new locations in the US for LNG, and that will be shipped overseas. So we'll have a major tailwind there from LNG capabilities in the US, and that will be by the end of 2024. And also, I think just the supply side is moving lower, okay, in the US. So the fundamental thesis for natural gas remains quite strong longer term. In the near term, I would say it's about a coin flip here, but we do want to see if it does find support at this rising 50-day moving average. Stock market correction. So I was talking about that in mid-September. Pounded the table on that during a couple of these weekly videos. So I absolutely got that one correct. The market has done quite poorly since the beginning of September. So that's another thing I've gotten right. Gold rebound, we talked about that. And then a specific gold miner chart. I talked about this a couple of times in late September, early October during these weekly videos. I am gold IAG. Well, this has had a 20% move since the first week of October. So definitely got that one right. I'll talk more about that in a second. So a few things I've gotten right for sure. One thing I've definitely gotten wrong, MindMed. This has been a debacle in September, October. And even though I still think it's pretty attractive, the stock is pretty attractive. It's trading under its cash on its balance sheet. They have over 100 million in cash. The market cap is something like 70 million. I think I'm just in the penalty box on this one. So whatever I say doesn't really hold any value because I've gotten it wrong. I've gotten it wrong. And I don't really have much confidence in this company at this point in time. They don't respond to emails, phone calls, and I feel like their corporate communications are sort of lacking just overall, right? So I would continue to have MindMed on my watch list, but from a trading standpoint, I got this one wrong here in the last month, and so I'm going to just put myself in the penalty box on this one for the time being, and we'll see if I revisit it at a later date. So that's one that I definitely got wrong. And just from a technical standpoint, this one, stopped out at the end of September, and there's no technical setup here to get back in yet. So we'll just have to wait and see if we revisit this at a later date. There are definitely some interesting fundamental catalysts that could be coming up for the company, but at this point in the penalty box, I need to see it to believe it. Uranium. Where's uranium on this? Did I put your? Oh yes, uranium sector update. So uranium has given some nice Cameco, URA, the big stocks to trade the sector have given some nice trading opportunities in the last couple of weeks. But if I pull this out to a 1-year chart, I can make some observations. The uptrend is clearly intact. It had a correction, a pretty violent one, sort of working on forming a bottom in recent weeks. And at the end of last week, Tuesday, Wednesday, Thursday, it started to move up. The spot U308 price is about $70 a pound. That continues to stay strong. And really, there's nothing that has changed since September to derail the bullish thesis on uranium, period. The only thing that I could say that would be potentially negative is just the overall macro backdrop and the stock market not doing well, right? So these are stocks. Cameco is a large cap stock. The URA obviously is an ETF, and they're affected by investor sentiment and overall market flows, outflows, and inflows. Okay, and obviously it's a niche sector, it's a small sector, and when sentiment rises and investors want to go in, it can have very big moves, just like it did from May to the end of September. This correction, this pause, is absolutely healthy. And I don't think if you're a long-term investor, there's any reason to sort of think about trying to get off this trade at this point. Okay, there's absolutely no reason to get out of this strong trend to the upside in the uranium sector. Another thing that we want to be thinking about here in the next week or so is seasonality. So one of the major seasonal tendencies in the uranium sector is the November through January trade. November tends to be a very, very good month for the sector. And for some reason, we see stocks like Cameco or, NextGen start to move up around like November 10th. It just sort of just happens on a regular basis, right? And this sector definitely has tailwinds coming into effect here for the next 3 months. I mean, an average gain for the URA of about 10% from November through February. That's a pretty good tailwind. And this is over a sample size of 14 years. Okay, so it's a pretty good seasonal trade here that's coming up for uranium. Ways to play it, the simple ways to play it: CCJ, URA, and then obviously if you want to get more risk, you can move down the food chain into the juniors. I would be focusing on juniors that have exposure to the Athabasca Basin. I think that is the hot address. That is the place to be to benefit from the next phase of this bull market in uranium. Moving on. Hercules Silver coming to the end. The football game just started, so I'm going to have to cut this short pretty quickly, but gold miners. So we're going to talk gold miners and we're going to talk Hercules Silver. So the gold miners have had a nice move in October. Okay, this has been a pretty solid rally in the GDX from $26 to $30. That's a pretty solid move, but just look to the left on the GDX chart. $30 thereabouts is a resistance level. So we ran into it. We hit our head on the $30 level Wednesday and Friday, and we pulled back a little bit. Now, I think the most likely sequence of events here in the gold miners is to see a little more pullback early this week, maybe Monday, Tuesday, maybe even into Wednesday. Could be a pullback, it could be a drop back down to 29 or even 20.50, or it could just be more of a sideways oscillation around 29 to 30. Either one would work just fine. And then what will come next? That is the key question to answer. And I think that if I'm right about gold and that this move is not just going mean revert back down to the 1800s. If I'm right about gold, I think that in early November we could see the next leg higher in this gold miner rally. Again, this is a very hated sector, very much under-owned sector. And I think you add it all up with $2,000 gold, and we could have another move higher in the gold miners in November. Now, obviously, these big technical levels, like on GDX, $30, on NEM, Newmont, $41 is the big level. AEM, which is, Agnico, the level's about $51. All these stocks ran into IM Gold, that level is 250, right? So you can just go across the gold miner charts. They all ran into resistance last week. So a pullback, a little pause, consolidation for a week or so is completely natural, completely normal and healthy. And I think that's what's in the cards here for early next week. And then we will have the potential for that next move higher. Okay. And that's the one where if you're a trader, you don't want to miss out on that one. IM Gold 250 is a big level, ran right into it, printed a shooting star on Friday. So just like I said, for the sector, I could see IAG pull back into the 230 area. So maybe like a 5% or so further pullback. And then we will see if it sets up for that real thrust higher where it breaks above the 250 level. And maybe, it can generate even 20 to 30% of further upside by year end. West Dome, so this is WDO. This is traded on the TSX in Canada. This is a weekly chart. This is a gold miner that has been displaying impressive relative strength for weeks. Actually, it's put in place a series of higher lows since the first couple months of 2023. It bottomed in January. Also lower highs though. So it's forming this sort of triangle pattern, pennant you could call it. And sharpen my pencil. The breakout level on this one is 840. So we want to see a weekly close above $8.40 on the TSX WDO. That would confirm an upside breakout from this big, triangle pattern that it's been forming so far in 2023. And if it does break out from that, it has a lot of potential upside. I mean, I think $10 would be just getting started. Okay, this could have a very significant move higher over the next 6 to 9 months. Okay, in the event of that confirmed upside breakout. So West Dome, mid-tier gold producer, Canadian, of course. So I'm just simplifying things a little bit. And yeah, okay. So Hercules Silver. All right. We're down to the last one. So first, so let me do the disclaimer. I own Hercules Silver shares. I have no other relationship with the company. I know the CEO. His name is Chris Paul. I've known him for a little while. Some other companies that he worked with. So I did this X space last week, and you can see I posted the recording of the space to YouTube. It's got some pretty good attention, 435 views just on the YouTube. If I go to X, formerly Twitter, there's been over 2,000 people that have tuned into the recording of that space. So that is phenomenal engagement, really big attention for a junior mining company. I'm not going to go to the whole story on Hercules. By the way, from now on in this conversation, I'm going to call it BIG, which is its symbol on the TSX Venture Exchange in Canada, BIG. So BIG, I'm not going to go into the whole BIG story. You can go through the presentation, take a look at their website if you're interested in learning more. A lot of you tuning in probably already know the story pretty well. But the fact is, this company appears to have made a major new copper porphyry, a new discovery of a copper porphyry system in Idaho. Okay. And it's early days. Okay. It's early days in this new discovery. Okay. There's a lot that we don't know at this point in time. So that's also a major caveat, sort of warning sign. This is early stage, exploration. There's a lot of things that could go wrong still. There's a lot of things that could go right still, right? There's a lot of uncertainty. So I'm just going to flip down to the sort of end of this. And they've been drilling deeper holes, right? So there's silver near surface. In fact, there's a resource silver near surface. But there were a lot of clues, including an IP survey that generated a very significant uh, anomaly at depth that had them decide to drill deeper holes. So here's the big 3D IP anomaly at the Hercules Silver project. And they decided, okay, we're going to test this theory that actually the silver near surface was being fed or leached out from a bigger porphyry system. So you have this big chargeability, anomaly at depth, and they tested it and they had success. So you can see here is the hole 2305, 45 meters of 1.94% copper, and a nice little sprinkle of molybdenum there in this hole. So this is a very impressive zone, sort of layer in this system that generated significant copper grades. I mean, almost 2% copper. That is, if you can tap into 2% copper over a sizable area, you have a deposit. Okay. The reason why this was left undiscovered for so long has to do with the fact that it was blind, right? So there's no surface, expression, right? There was no expression of this bigger copper porphyry system at surface. And all the historical work at Hercules was done looking for silver and focusing on the nearer surface holes, 50-meter holes, 100-meter holes, not drilling 400 meters or so depths to sort of look for something bigger and deeper. And that's the way it is with all exploration, in 2023. You're not going to find anything new that's really close to surface. All that stuff's been picked over and found, right? So the new discoveries that people are still making are always deeper. They're always 300 meters, 400 meters, even 1,000 meters deep, right? So putting together all the pieces of this story, and actually don't listen to me, really, you should just listen to the conversation I had with Chris Paul last week, because he explains it better than I ever could, right? But all these new discoveries are deeper, right? And the fact is that this hole, so look at the entirety of the hole, 185 meters, grading 0.84% copper, and again, a nice sprinkle of molybdenum there. That's showing evidence that there could be, keyword could be, a significant, deposit here at depth, right? And in the conversation I had with him, he offered a lot of very sort of compelling comments. And that is one of the things that he talked about was the IP. And, they're doing another larger survey on the project, 3D IP, and it's showing them that this is a big system. Okay. Now they haven't publicly posted that. They haven't published the results of that entire 3D IP survey, but that will be coming in the future. But basically, in this conversation I had with him, he made it pretty clear that this looks like a very big system, and they're getting a better handle on which way it's trending. And it appears that it's trending to the west. Okay. And then, a lot of other talk that mainly would be understood by geos, but he's basically telling us that it's very unlikely that the first hole, this hole 2305, is going to be their best hole. Okay, it's very unlikely. There's probably a lot better to come in the future. So, he's the CEO of the company. He's obviously biased, but it's also unlikely that he's completely full of shit either, right? In making these statements to thousands of people on the internet, right? He probably has some data backing up the things he said in that conversation. We'll probably find out some of that data over the coming weeks. So overall, the conversation was quite compelling. And I even made a joke afterwards on co.ca that everybody should take a cold shower now, because it's, talking to a CEO and how excited they are about the work that's ongoing at their company's project. It can be very easy to get caught up in what could be the possibility, the sort of pie in the sky, the potential, and we can sort of lose sight of the reality that these things take time to come together. There's going to be a lot of drilling done. There's already been a lot done. We haven't seen the results of all of it. We're going to get more of those results over the coming months. And every hole is probably not going to be a boomer hole, right? So there'll be times when a company puts out results and the results are disappointing to investors. Just like it's quite possible that big could put out results that could be really a good surprise to investors, right? So we're probably going to have both sides of the coin. We're going to be disappointed and we're going to be enthralled, right? And the stock is going to be a representation of investor emotion. So right now, as you can see, from this breakout from 25 cents to 63 cents, that investors are enthralled by the sizzle, right? So the first hole targeting this deeper porphyry system, this copper system, the results and the potential of the coming holes have investors captivated and excited about the potential, right? And so there have been a couple of down days, but only two. There was one big down day last Monday, and it looked like, bearish engulfing candlestick, the top is in, and then nope, right back up. And it's clear investors are buying into the story for the results to come. There's 7 deeper holes that the company will report over the coming months. Probably that'll last us through the end of the year, maybe even into January. And investors want to be positioned ahead of those results because they think they're going to be as good or better than the results of this hole. I do want to say that I bought it on the morning that they put out the results of 2305. I actually got in at 29 cents. Posted that in my private channel, the Trading Lab. And that's been a pretty good trade. I got a little lucky there, but it's been a pretty damn good trade. I don't know what the future holds, and I don't have a target price. I know people are going to ask you, what do you think this could be? Well, I don't know what the results of the next 7 holes are. If you could tell me those, I'd have a much better idea of what the share price might be, but I just don't know, right? I will just make an observation. The market cap is around 120 million in Canada, so it's less than 100 million US dollars is the current market cap of Big, the company. And big copper moly porphyries. I'm going to point out one in South America. This is owned by Solaris. Solaris has nearly $1 billion market cap. And in 2022, when the copper price was significantly higher, Solaris had more than a $2 billion market cap. So that's just, this is way more advanced project. They have measured and, indicated resources, pretty large scale you can see here. But you can also see the grades. Okay, you can see the grades here. And you can see the grades here. So I'm not going to say any more than that. Obviously, we need a lot more information, a lot more data, but the potential is quite significant. And this is Idaho, and that is Ecuador. So that's also something to point out and factor into any price targets or potential future valuations. I think a copper moly porphyry in Idaho would receive a significantly better premium valuation to any deposit in South America. Okay. So yeah, I also want to point out just the weekly chart. So from a technical standpoint, the volume and just the shape. So I use the shape of the breakout, the consolidation that led up to the breakout, and then the velocity of this breakout is powerful. And a lot of people seem to think every gap needs to fill. It doesn't. It doesn't. Look at Great Bear and some of the gaps that it left in its chart all the way back in 2018 that never got filled in, right? So the best ones, the best stocks, the new discoveries that are actually real discoveries that warrant attention from majors and eventual buyout from majors, those gaps don't get filled in. So again, I'm long. I don't have a price target for you. I can assure you there's going to be a lot of volatility in the share price and in this chart over the coming weeks and months. And also, there's going to be a lot more data coming out that's going to help to fill in the picture. And some of the data could be disappointing. Okay, so that's just talking facts. Okay, we just don't know. This is a speculative sector, and a junior mining stock is about as high risk as you can possibly get in the stock market. All right. So that's it for me on the Sunday night. I'm going to watch some football. I hope you guys have a great trading week. And again, if you found any value in this video, if you like this, hit the like button and please subscribe to my channel. Also, you can follow me on Twitter at CEO Technician or on ceo.ca at Goldfinger.